the whole economy is not contracting, although I would argue that there are sectors that are contracting. And in fact, when you look at the data on a state by state basis, half the US economy regionally is actually in recession. And it's the half that's not in recession that is creating the conditions for being just above the zero line. But that's where we are. The question is, where do we go next? We've gone from 3 into a 1 to 2% range. What's the catalyst? What is the catalyst that takes us back to 3%? I just don't see it.
Welcoming David Rosenberg to speak up. David, thank you for joining us. He is the founder and president of Rosenberg Research. He had a long career in banking and, of course, an epic run at Merrill Lynch as chief of investments. Brian Hull, does that name sound familiar to you? Do you remember Brian by any chance?
Of course. He's also a client and longtime friend and mentor.
Yeah,
he
no,
was
Brian,
probably one of the reasons why I didn't get fired at Merrill for being the skunk of the picnic all those years.
See, Brian Hall, everyone that listens to Wealthy On knows who he's everyone's best friend. He's the O positive donor of friendship on Wall Street. All right, well, let's go right to the economy, if you don't mind, sir. I'm regaling at your books. I probably want to take a picture and see how many of those books I've actually read. Let's go to the economy, sir. What do you think? Fed going to cut rates in July?
Well, nobody else seems to think that July is on the table, but I'll tell you this much. If we get another really great CPI report next month, and if we get some more confirmation in the next employment report that the real deal was the household survey, not the payroll survey, then I would say there's a chance they can go in July. I could tell you that, unlike most other people, I'm not saying that it's 0%, but I'd say that, what could make sense is that we get Jackson Hole in August and Powell uses that to set the table for a cut in September. So I'm actually leaning towards September, but I'm not ruling July out.
Okay, 2 cuts, 3 cuts this year? 1 cut, 0 cuts?
Well, the calendar sort of gets in the way. You know what's interesting? I think it'll be 2 or 3. A lot of people think 0 or 1 or 1 or 2. People think that the election's going to get in the way. I'm not really so convinced about that, although it is interesting that the FOMC meeting comes a little later in November this year, as in 2 days after the election on November the 7th. I would say I'm still in the 2 or 3 camp, and I'll tell you why I'm not ruling out 3 cuts is because of this. You go back to last March, when the median dot plot was still fractionally in the 3 rate cut camp. Where was the Fed's year-end forecast for headline PC inflation was 2.4%. We're 25 basis points away from that right now. Where was the Fed's year-end prediction for the core PC inflation rate was 2.6%, and we are the grand total of 15 basis points away from that. For all the hand-wringing over inflation, we're so close to the Fed's year-end predictions on headline and core inflation, and yet everybody's talking about 0 or 1 cut, and yet back then when they had these predictions in March, it was 3. Not to mention the fact that the year-end projection for the unemployment rate was 4%, and that's where we got to last Friday. This was all consistent back in March with 3 cuts. I know everybody swung to 0 or 1 because everybody swings with all these verbal pivots by the Fed. I get a sense, data permitting, that they'll be pivoting again in the opposite direction by the end of the summer.
It's interesting. I'm friends with Steve Cohen, the Met owner. He's been fairly consistent since the beginning of the year that you'd see 3 cuts. Our economics team here at Skybridge thinks that there's still going to be 3 cuts. And it was just interesting to see how we went from 7 to 3 to 0. So I'm in your camp, David. We'll have to of course see what happens, and I think he cuts in July. That's just me personally, because I think it helps him if he's going to start cutting. Let's start cutting before the election and get the cuts out of the way. That's just my opinion, but who the hell knows? Mortgage applications are down. Purchases for homes are lower by 4.4%. We've also seen refinancings down 6.8%. And you and I both know that housing is the heartbeat of small businesses. Many of the small businesses in the United States are tied to housing. That's where we see a lot of our job creation. Are you worried about that? Do you think the Fed is worried about that? And where do you think housing's going from here?
Well, housing has been in the doldrums, not prices, but volumes. For the better part of the past couple of years, we had a hiccup uh, in the first quarter, but you look at all the incoming high frequency data on housing starts and home sales, and they're rolling over again. And of course, in lagged response to the bond induced run up in mortgage rates. It's a this is the most complicated housing market that I've seen in my 40 years in the business, and a lot of it is the byproduct of COVID and the dramatic decline in interest rates to historically low levels, and then everybody and their mother locking in at those lows. And very fortunate, very good move, but they become prisoners in their own units. So existing homeowners, there's no turnover. They're locked in. They can't move. So there's no inventory. There's a dearth of inventory in the market for resale homes, which is 85% of the total market. And what's really interesting is because it's a completely dormant market, you've got sales are negative. Sales are negative year over year in the existing housing market, and yet prices are up like roughly 5-6%. So we flipped economics on its head, where demand goes down and prices go up. Very unusual, except for the fact that we have a very sclerotic, inelastic supply curve for housing in the resale market. So even with weak demand, the supply curve is so anemic that prices go up. And of course, that even, along with higher mortgage rates, forces fence sitters who want to come into the market, they just get crowded out. That's why the home building stocks, for the better part, have done well, because that's been the only valve if you want to buy a home. That's where the inventory is. And it's interesting that in that segment of the market, sales are up and prices are down. So it is a very bizarre and bifurcated residential real estate market. I would just say that, the most unusual thing that I'm seeing in the data is this: that although the economy is really, if there's one source of positive in the US economy, it's this resurgence in productivity. It's running 2.5% year over year, which is very good out of nowhere. We just don't know the extent to which is that a secular trend. It seems a little early for AI to be generating that, or is it cyclical? But the one sector where productivity is sinking is in construction. You've got this bizarre situation where the employers in the construction industry are hanging on to their staff, even with depressed levels of construction spending. And I'm waiting at some point for something's got to give here. Either construction spending's got a balloon, but that's not happening in the data, or the construction industry has to start laying off people, and rather significantly. That could be upwards of about 1 million people could lose their jobs in construction if things don't pick up, because that's how bloated the payroll is in that sector.
So I want to sit back for a second, because you and I have been doing this a long time, and I'm looking at the economic dashboard of the United States, and it feels okay to me. But now I'm wondering if I have the confirmed biases of the group of people that I hang out with, which is mostly Wall Streeters and, frankly, elitist snobs, if you don't mind me saying so. So I also hear from my buddies that are in the blue collar world that they're not as happy, that the inflation is eating up their disposable income. There's economic anxiety about job stability. And I feel like we're in a tale of two economies. Am I wrong about that, or what am I missing? Um, because in an economy like this, looking at the dashboard, you would say, okay, the incumbent president of the United States is going to get reelected. But the incumbent president of the United States has a 37% approval rating. And at this stage in the election cycle, that's the lowest that any incumbent president has had since they've been recording this stuff. So isn't it the economy stupid, or am I wrong, David? Tell me what you think.
Well, I think the reason why so many people think the economy is so strong is because they take their cue from the stock market. But the stock market is not the economy. But that's why they think everything is so great. If you remember that the S&P 500 hit its all-time high on October 9th of 2007, when I was working at Mother Merrill, we peaked at 1565. I went into the Fed in Washington and gave them a presentation on the day of the peak. And at the end of my presentation, because I was calling for a recession and I was laughed out of the room. And one of the research people there said to me at the meeting, Mr. Rosenberg, do you not realize that the stock market actually hit a record high today? And what do you know? The recession that nobody saw coming began less than 2 months later in December of '07. But you see, people conflate the equity market and the animal spirits in the equity market to what's happening in the economy. They're not the same thing. And it also comes down to why there's this bifurcation, not just between the high end and the low end, but also between the high end and the middle class. Because when you look at the data and you look at the socio-demographic data and you look at where the concentration of wealth is, and we're talking principally equities and housing, it's mostly in the upper class. So they are rolling in, I'm not going to say rolling in the dough, but they're certainly rolling in the net worth from what's happening in terms of asset inflation. If you're renting, you're not getting a benefit from the housing wealth effect. And most people in the lower income echelons in particular just don't have the money to put in the equity market. So, that's that's the real story in terms of high end versus low end. However, when you listen to the retailer reports in the latest quarter, you're hearing a lot of high rollers are now shopping at Walmart or Target. Like they're starting to trade down as well. But there is a huge growth gap between the high and the low end. That much is true. And in terms of the interpretation of the economy, I just tend to find everybody is looking in the rearview mirror. Yeah, we had a strong economy last year, 3% real GDP growth. And 100% of that growth came from the fact that the Biden team widened the fiscal deficit by 25%. Imagine that in a sub 4% unemployment rate. The deficit expanded. That's virtually unprecedented, but that added to growth because government is part of that GDP. So huge impetus from government. And then we had the final chapter of the excess savings file in the consumer sector. The history book showed that when confronted with a stimulus check, the household sector, which has always been narcissistic to a certain degree, but never like this, between YOLO spending and anger spending and revenge spending, all of the $2 trillion Biden fiscal stimulus checks doled out in 2021, it all got spent. And it was a gift that kept on giving right up until the end of last year. Of course, the San Francisco Fed, who I believe actually produces the best research among the federal district banks, wrote a report recently showing that all of the excess savings have already been spent in the economy. That had a big impact last year. The fiscal deficit expanding had a big impact last year. And of course, we had a double-digit growth boom in credit cards, which are now being cut up. Because the delinquency rates have hooked up to the highest level in 12 years. Those three things together, credit card boom, the last leg of the excess savings file, and the rampant expansion of the fiscal deficit, believe it or not, without those three impacts, GDP growth last year was zero. Now, some people will say, well, Rosenberg, you're data mining, to which I say, no, that's just analysis. That is, if I was an equity analyst writing up a report on this as a company, I would put an asterisk at the bottom saying non-recurring items. And then we fast forward to this year. I remember months before first quarter GDP was released, the Atlanta Fed was like somewhere close to 4%. What do we get? We got 1.3. And the second quarter looks like it's coming in somewhere between 1 and 2%. So you would argue, well, maybe that's not a recession. But when I started on Wall Street back in the mid 80s, we would call 1 to 2% growth stall speed. And that's where we're heading into. So the economy is no longer strong. It's weak. Is it contracting? The whole economy is not contracting, although I would argue that there are sectors that are contracting. And in fact, when you look at the data on a state by state basis, half the US economy regionally is actually in recession. And it's the half that's not in recession that is creating the conditions for being just above the zero line. But that's where we are. The question is, where do we go next? We've gone from 3 into a 1 to 2% range. What's the catalyst? What is the catalyst that takes us back to 3%? I just don't see it. So I think the economy is soft. I think what's most important is that the growth in demand, which is what GDP is now slowing to a trend that is well below the growth rate we're seeing in aggregate supply. I know I'm talking like a very nerdy economist, but the reality is that if you don't have a demand and supply curve, you can't forecast inflation. And so I don't need, or the Fed doesn't need a recession to trigger lower interest rates over the course of the next 6 to 12 months. And that's my highest conviction call.
If I had to ask you for an actionable thing, we always ask people this, and something actionable is a trade that you see, there's a market that you like, there's something in the marketplace right now actionable. What would you do? Anything you see right here is okay, this is a layup?
Well, I think that you and I seem to have a very similar view on where the Fed's going to be by the end of the year. So I think being long those Fed funds futures contracts that aren't priced for enough Fed easing, that to me, I'm not going to call it a layup, but that's a strong conviction call. I think that inflation, and we're starting to see a significant break in the culprit that caused the deviation in the inflation numbers this year, which is auto insurance. And actually that deflated modestly in May, very thankfully. And I think the rental numbers are starting to slow down at the margin. I think that when I'm taking a look once again at what's happening, the broad contours in the U.S. economy and the excess capacity in the product and labor market that I see unfolding, I think that these pressures will bring inflation down to 2% by the end of the year and down closer to 1.5% by the end of next year. So I'm very bullish on the Treasury market. I think that you will not get as much of an impetus, given how inverted the curve is, in terms of yield decline at the long end of the Treasury curve. However, I think that that'll be your best total returns will be, say, in 10s and 30s. And if you're a trader that trades around the curve, I think the curve will naturally re-steep into a more normal slope. Once the Fed starts to play catch up to Canada and to the ECB, I think you'll find that the dollar is going to start to go down. That might be a call for later this year. And in next year, that's going to be very good news for the gold price. On top of that, I think in the FX market, to me, the Japanese yen seems like a coiled spring here. And the BOJ will be snugging policy as everybody else in the world is cutting interest rates. And there is nothing more undervalued on the planet than the Japanese yen. So if you're in the FX world, you might just want to buy the Japanese stock market unhedged and take on the currency too. And within sectors, look, I think that recession risks have not totally subsided like everybody else does. I have a very more, call it defensive and cautious approach towards the equity market at these valuation levels. However, given my interest rate view, I want to own what I call bonds and drag in the stock market. And the poster child for that would be the utilities, which have actually been a good place to be. And they seem to be re-rated for longer term defensive growth characteristics and, of course, benefiting from AI. But I also like utilities because when rates go down, their dividend yield becomes more attractive. So that's what I would throw into the pot as far as what sector I'd be focused on.
Okay, so we got a few minutes left here. Let's go to some. It's great stuff. Thank you. Should I be in USD for the crash, or look at ETFs like TLT, EDF, and ZROZ? So I don't think we're crashing, Elizabeth, from Miami, but I'll turn that over to David.
Well, I don't think the U.S. dollar is going to crash. You know, I mean, I've rarely.
I think she's implying a stock market crash or a
Oh well, you
some
know,
type of market-based apocalypse.
I don't. Well, I mean, I guess there's always tail risk. You know, can the stock market collapse? I mean, normally when you get a collapse in the stock market, it's around a financial crisis, like what happened in '08, or a health crisis, like what happened in 2020. So I don't think I would formulate a base case around Armageddon, but you know, I'm looking at you know, an equity risk premium in the S&P 500 that's now flirting near zero. I mean, you're just not getting paid to take on the capital risk in the stock market. You're paying to take on that risk, and that unnerves me. I don't like the valuations. I think the sentiment is wild, and you know, I hear all the time that this is an earnings-driven stock market, and no, it's not. Earnings are up 6% over the past year. So if the stock market was up 6%, I'd say, granted, it's an earnings-led stock market, but the stock market's up more like 25%. So like 4x what earnings are doing. And that's just basically because most of this last leg of the rally to the highs has been purely multiple expansion. So I'm just nervous that too much is priced in. And valuations aren't a timing tool, 100% true. But at any given moment in time, the valuations in the stock market, the multiple tells you something about expected future returns. And I would rather invest with a tailwind than a headwind. And the multiples right now are a headwind. And then we talk about market concentration. I mean, a third of the stock market now is back to being technology. We're heading back to where we were in the late 90s, early 2000s. So there's the concentration risk. There's the valuation. There's the fact that everybody seems to be all in. And I'm a contrarian at heart, so I am not bullish on the stock market. You can classify me as bearish. I'm not in an Armageddon camp because it would take some sort of real tail risk or financial shock or something like that. But behind the U.S. stock market, all I'll say is I just don't like the math. I don't like the math right now behind it.
Mm-hmm. Fair enough. Okay, just two more quick questions, and we'll have you out of here, David. Thank you so much. GameStop, they raised over $2 billion from the roaring kitty trading frenzy. Do you see social media influencers continue to manipulate the market or crypto meme coins? This is Jordan from San Diego. So I think that that's going to be with us for a very long time. What do you say, David?
Yeah, I mean, I don't disagree, you know, unless, you know, the regulators step in. Always a risk. That's also a risk for AI. But I would say that, I mean, to me, I sort of put that aside. It could just be, once again, you know, Bitcoin over 70,000, GameStop, the meme stocks. It's part and parcel of the mania. It's part and parcel of really the mania that we're seeing in certain parts of the market, the parts of the market that really are commanding everybody's attention. So it's all part of the same trade, and it's really all part of really the generative AI trade. Lots of hopes. I mean, to me, the chip stock craze reminds me of the fiber optics craze back in the late 1990s, and we saw what happened And what naturally is going to follow is overcapacity and deflation, so on and so forth. But these are everything that you're describing to me is just what I was talking about before. It's all about animal spirits. People could say, well, to the Fed, this is a sign that there's excess liquidity in the system. I'm not so sure about that. I mean, take a look at we know what the Mag 7 are doing, or maybe now it's down to the Mag 5 or the Mag 1. But the rest of the market has lagged well behind, and actually earnings in the Mag in the S&P 493 is actually negative 3% year over year. So everything is skewed towards froth, concept, what's sexy. And it all speaks, including your opening question on GameStop, to just swaths of the market that have a very high speculative bent.
So where do we find you, David?
I'm not participating.
Where do we find you, sir? Before I let you go, where do we find you? Are you on Twitter? You're on Instagram?
Not Instagram, but on Twitter. I have my own YouTube channel. For anybody that wants to subscribe, we'll offer anybody on this show a 1 month free trial. You just have to Google Rosenberg Research, takes you right there, or you can just Google. This is probably the best way to reach me, information@rosenbergresearch.com. And one of my client service people will get back to you ASAP and get you signed up for a trial.
Awesome. All right, sir. Well, thank you very much. You've been generous with your time, the legendary David Rosenberg. I agree with you on the Fed. Let's see what happens, sir. Hopefully you and I can revisit this before the end of the year to see if we're right about where the things are going. I wish you great success. If you like this video, you'll like this video as well. Check it out.